Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here is your weekly technical analysis of New York and London sugar markets. I'll start with ICE raw sugar in New York. The most recent significant move, until last week that is, was the combined key reversal down and bearish engulfing pattern made Monday 3 weeks ago. That action had a follow-through low that lasted until the start of the week before last, but was halted by the combined support between 1630 and 1681. This support includes within it the 2021 50% Fibonacci line at 1681, as well as the fairly flatlining medium moving average, currently 1678. This halt opened the way for an immediate countering key reversal up and bullish engulfing pattern 2 Thursdays ago. However, as a reactionary move, it lacked depth, and last Monday we had another key reversal down. However, as I said at the time last week, and I quote, "I'm not too hopeful for any significant follow-through lower. After all, we are so close to the support band 1630 to 1681 that you may only have a small move lower after that." And end of quote, and I was right. The very next day, that is last Tuesday, we had a small but significant immediate countering bullish Harami and a bullish white Mariposa. Since then, it has been all the way, including today, up. It is interesting that I have so often repeated the words initially uttered some 6 weeks ago. This market is still, and I quote, going to be between the support 1630 to 1681 up to the 50% 21st century absolute Fibonacci line at 1809. End of quote. I added last week, and again I quote, that is until it changes course. One day this market is going to make a break, one way or another. For the moment, the recent head and shoulders is dormant, and the middle time, currently at 1746, of the ever so mildly bullish December 2020 to March 2021 shift pitchfork is just showing a gentle direction higher despite the key reversals down. Today we've seen an attempt higher over the key 21st century 50% Fibonacci line, absolute Fibonacci line, and closing right on that recent downtrend. The difference this time from the late June, early July action is that we've already had a close over the 1809 level last Friday. If prices do so again, which I have done today consecutively, then the 2021 high at 1894 will be in the frame. ICE Europe white sugar. The interesting February to May shallowly bearish shift pitchfork continues to give the bearish angle of attack. The market is in between the declining middle time, currently 441.80, and the upper time, currently 477.90. Okay, since the middle of July, when the market reached down and made a new low for 2021 at 412.5, we've seen a recovery all the way up to the combination of the following: the short medium moving average currently at 446.5, the medium moving average currently at 448.10, and the current 50% Fibonacci line for 2021, which is not that different from the early one, and that's at 451.40. Please remember those numbers, as they will shortly become important again. Anyway, what was interesting was the move up breached all of those overhead resistances, but did not close over any until last week, when prices started by closing over the short, medium, and medium moving averages. Okay, let's take a step back. The last time prices were up at this congestion, there were no closes over it, despite some serious attempts higher. This failure back then to really break this overhead resistance, especially on a closing basis, caused a subsequent decline that finally halted last week down at 412.5, but which was really broken once again by the interesting 38.2% Fibonacci line of the April 2020 to February 2021 move at 419.30. Now, 2 weeks ago, we had the break back up late that week. This continued last week, on last Monday, but with what ended up being a higher but still bearish opening black Mariposa. Now, you remember I asked you to keep those two moving averages and that 50% Fibonacci number in mind earlier? Well, prices closed below all of them last Monday. However, this was not followed through last Tuesday and Wednesday. We did have indecisive spinning tops those days, but they were higher importantly higher over the moving averages, and by last Friday over the 50% Fibonacci line at 451.40, and the highest close since mid-June. I'm still a bit mystified by the relationship between last Monday and the rest of last week. Anyway, we're trying now to make a second high close over, and we have done over all the previous congestion, and maybe over the, well, actually ended up closing over the high of February 2020 at 456.60. So going back to what I said earlier, overall the market is still held within the February to May bearish shift pitch hook, at the moment in between the slowly descending upper time 477.90 currently and the middle time currently 441.80. This bearish pitch hook is barely imperceptible, and we have resistance currently at 460.5, 469 even, and 474.80 before we reach the upper time. There are some other things you should also look at. At the current count, we have a possible big double top over 2021, possible smaller double bottom over March to July, and even smaller double bottom over June to July. Last week I said that I'd be hoping soon to have these sort their priorities out and give a clearer signal. Well, at the moment it seems that June to July smaller double bottom is the most immediate feature. We're coming very close to breaking upwards from this. What today looks like to be a key reversal up, which we didn't quite manage, actually managed an outside day. If we do, then we have a provisional target X in the 495 even area. Now this is a big ask, as it is beyond the upper time and the current high for 2021. However, it all depends if, and it is a big if prices can clear on the upside the double bottom neckline, the lesser Fibonacci level at 460.5 by a sufficient margin, and have consecutive closes over it as well. So there you have it. So far we've not seen that, but by saying it here, it gives an opportunity to monitor should it happen between now and say next week. Sugar white premium spread. A very clear pattern 2 weeks ago here. A weekly key reversal up based on the middle time, currently 46.75, of the big bearish May 2020 to February 2021 Andrews pitchfork. This pitchfork has been showing the bearish angle of attack of this market since February. As I said some 4 weeks ago now, and I quote, "Please note this is a declining support, as is appropriate for a bearish pitchfork. So please do not think of it as any form of counter to the overall bearish incentive." That is currently evident here. It is as I pointed out 2 weeks ago, which is actually now 6 weeks ago. Until we see the market move out of these strictures, then this bearish pitchfork will prevail. End of quote. So last week initially started with a gapping move higher, which the market halted just short of the first significant overhead resistance of note, the neckline of February to November 2020 failed head and shoulders top, currently at 75 even. This is not a strong resistance, and I was a little surprised to see the market halt before it, but it did so and turned right back down, so that last week closed only $1.75 higher than the week before. This week we've started in between the two and then headed lower. It would not be surprising to see the market utilize the middle time much the way it was in mid-June to early July as a rolling declining support. After all, it is a bearish pitchfork, as I've said all along. Beyond that, we have support at 41.75, 40.25 and 26.25. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.